Is now Evan Brown, portfolio manager, head of multi-asset strategy at UBS Asset Management. Thanks for joining us. You're all set. We've been waiting and waiting for that scary inflation print from the tariffs. We're not going to get it this week, you don't think, but this is the last one that lulls us into. Are we in a false sense of security?
Well, we should enjoy this print while we can, because yes, you're going to start seeing after this month the inflation prints really start to accelerate. Core CPI had dipped finally from above 3% into the high 2s. We're going right back up above 3% because of the tariffs. But we shouldn't get too concerned. I think what the Fed is mostly focused on is inflation expectations. And actually, we got the New York Fed's inflation survey yesterday, and that actually showed inflation expectations moderating. So hopefully that continues, and they can see this inflation jump as more of a one-off.
So all the companies that are saying we're not going to raise prices, they're somehow doing something. They're surreptitiously raising prices, at least to where we get back to a core of 3%.
Yeah, I mean, I think it'll be a mix. Some will be absorbing some of the higher taxes in their margins. There will be some pass-through to the consumer. We
haven't seen it yet.
Yeah,
they're not. And the S&P is up 21%.
That's right. That's
the worst case scenario, but so it's just been put off. There's a negative scenario on the horizon, in your view.
I think I would just say, yeah, there are challenges that U.S. corporations are going to have. The commentary that we've seen so far from these companies and earnings is that they have the levers to pull. They can adjust supply chains. They're able to adapt, but without question, they're going to be pushing forward a lot of these price increases to the consumer.
And then, when does that show up?
So that'll be
next month.
Tomorrow will be the last print before we really get that. Yeah. It's really once we get into July, and that's the June data.
You're sure?
It's going to start happening.
You know.
I'm confident that
take your word. Okay.
Inflation
and we're not going to grow very much. It's going to be 1% GDP growth, which that won't help the dollar. Right?
Yeah, so, I mean, look, we've enjoyed really strong GDP growth over the last couple of years, growing at almost 3%, 2023, 2024. And we're just coming off, we've had that big fiscal impulse, right, which was unsustainable. We had the big immigration impulse, which was unsustainable, certainly politically. And now we're just coming back down. And so we're just going to see more of a muddle through in growth here in the U.S., which is not going to look that different GDP growth than some of our peers, Europe and Japan. And with the dollar still kind of overvalued, we do see room for the dollar to come down as U.S. growth normalizes a bit.
Does the market recognize that, what you're saying?
Likes the market after all this,
yeah.
And thinks that companies are going to do better.
Well, the dollar coming down is a big tailwind for U.S. earnings.
The market
right, when you
continues
translate it back.
to go up.
Yeah, so it's a muddle-through environment, but muddle-through environments haven't been so bad for the stock market. And in fact, you could argue if we were overheating right now with all the focus there is on the bond market, if you got some kind of yield spike, that wouldn't be a good thing, right? So you get okay growth, you get a dollar weaker, which is going to help company earnings, and I think we grind higher here.
But you think it's not clear sailing. The second half of the year, we get a growth scare, but when it's all said and done, we're still higher at the end of the year on the averages.
That's the thinking. I mean, we know that the hard data, the real activity data, the labor market is going to cool, right? That's all signs are pointing into that. It's just a matter of how fast. Our base case is that, it's a gentle cooling, but you might get some data prints here and there. Maybe you get a payrolls print that looks kind of close to zero, and the market's going to react to that. We could have a little bit of a correction, but all things said and done, we think we avoid recession, and the markets can end higher at the end of the year.
Evan likes silver, too. We were talking about silver earlier.
So do some other people. It's at
highest
level since February 2012.
But to me, 36 looks high. But you're saying relative to where gold is, it's at a very low point.
Exactly, yeah. So the gold to silver ratio is near record highs, and so there's plenty of room for silver to catch up here. You still have a tight market. There are deficits in silver, and I just think in metals, risk appetite is broadening out, and so that's a nice catch-up trade there.
We had a guest earlier who said he expects commodities broadly, but specifically the metals too, to really run. That's your take on it as well?
Yeah, we're starting to see Oil look a little perkier, copper beginning to break out. And by the way, these are things that you don't see ahead of a recession, right? So those signals give us confidence that the economy as a whole is going to be okay.